Hello everyone, my name is Gabriel Stein. I'm Director Asset Management Services at Oxford Economics. Welcome back to this, the latest in our series of podcasts on topical issues. I'm sitting here together with Ben May, lead Eurozone Economist at Oxford Economics, and we're going to talk about some developments in the Eurozone, notably inflation and bond yields. Ben, beginning with bond yields, we've just seen German bond yields shoot back up above 1%, and it's not long ago that they were down below, I think, 0.2%, and we were talking about the not impossibility that they might go negative. What has happened?
Well, I think it's really a combination of factors. To start off with, I think markets perhaps were exaggerating the risks of full-blown deflation occurring in the Eurozone, and also were perhaps too pessimistic about the near-term growth outlook. So as the economic data had surprised, and in particular inflation's rebounded, I think that probably took markets by a bit of surprise, and that prompted the initial rebound. More generally, though, I think there's probably been some technical factors that have probably exacerbated those moves. And also, I think the ECB probably hasn't helped. Not so long ago, Benoit Cœuré was talking about the ECB taking steps to try to reduce volatility, and I think markets overinterpreted the idea of that. And then Draghi turned around later saying they wouldn't do anything to ease volatility in the markets, and that market participants should just get used to it. So I think there's been a whole combination of factors going on, but I think what it is fair to say is that bond yields now are probably much closer to their fair value today than they were, say, 1-2 months ago.
Well, you're talking about a couple of interesting issues there. One is, of course, the intervention of central bankers, which we now see can go both ways, obviously. But let's come back to that later and talk perhaps for a brief moment about inflation. A few months ago, it looked the Eurozone was in deflation. Consumer prices were falling year on year. There were some indications that this wouldn't last, notably, and you would expect me to say that, broad money developments. But even with that, the recent inflation developments seem to have been surprisingly robust.
Well, I think certainly, if you look at the development since January, the main factor has certainly been energy and food prices, which to a large degree are being driven by global factors and the exchange rate, I think, rather than specific macroeconomic factors in the Eurozone. But you're right in the sense that core inflation has risen from a record low of 0.6% to 0.9% in May. It's difficult to know exactly what caused that yet, given that we don't have a full breakdown. But our suspicion is that was mainly down to some temporary factors, namely a surge in package holiday prices. And certainly, before the release was out, we predicted that there would be such a rise. And our view is certainly that's really temporary, and we're likely to see a bit of a fallback in core inflation in June. So I think fundamentally inflationary pressures in the Eurozone are still pretty weak, albeit the headline figure is substantially higher than it was.
They're weak, but they're positive. I think it's safe to say the risk of deflation of sustained deflation is now off already. But if the core rate now slips back again in June, could that then have a reverse effect on bond yields? So all of a sudden we see bond yields coming down again, or have markets now taken on board that where we currently are is a more realistic or a better state to be, so to speak?
Well, I think it's fair to say that bond markets have been incredibly volatile, and so any news like that on core inflation wouldn't surprise me if it did have some certainly near-term impact on yields. I think the big picture, though, is that what we're likely to see is inflation gradually creep higher over the next few months, mainly driven by energy.
Up to where?
Well, perhaps you're talking about being just under 1% by the end of the year.
Okay, so well away from deflation, but well away from targets.
Yes, but next year, actually, I think inflation will rise quite sharply. And that to a large part will be due to the sort of base effects from energy falling out and prompting more normal levels of energy inflation. But also we do expect core inflation to gradually creep higher, albeit to still pretty low levels in a longer historical context. But certainly it's quite plausible we'll be seeing in the early stages of next year inflation being not a great deal away from the ECB's sort of target rate of near 2%, and certainly that's something that could ensure that bond yields remain reasonably high, and that we certainly don't see a reversal back towards the kind of zero levels that we were seeing not so long ago.
If inflation does go back to target or near targets next year, or perhaps I should rephrase that, if it seems clear that towards the end of next year inflation is going to head back towards target and possibly even overshoot a little, do you think the ECB is going to start tapering its quantitative easing? For the moment, of course, they're swearing blind that nothing will stop them. 60 billion euros every month until September 2016 at the very least. But if it seems that inflation is picking up, if activity is improving, are they going to stick to that?
I think they will, actually. Certainly the ECB has made it very clear that its growth forecasts are conditional on QE taking place until at least September 2016. And really, if you look at those forecasts, they're for decent growth, for inflation of around target, but certainly they're not excessively punchy. So I think it will use that as a justification if activity continues to improve, that it won't be tapering. I think more generally, a good point to note is that next year inflation is likely to be close to target because energy inflation is quite high. Other things equal, it's probably likely that energy inflation will start to drift back again in 2017. So unless core inflation picks up quite sharply, then headline inflation could dip back to levels that are still perhaps a little bit below target in 2017. So in that sense, I think that will be another reason why the ECB might not be under too much pressure to instigate early tapering.
And what about moving to at least bring interest rates back to zero?
That's a tougher one to call, really. I think certainly when we get to the point where the ECB wants to start to normalise policy, you could argue that returning the deposit rate to positive territory might be done rather earlier, and then the policy rate might still be left on hold at that point at close to zero levels for a sustained period. I wouldn't necessarily rule that out. But even so, our central view is really that we don't see any interest rate hikes until sort of late 2017, early 2018, as things stand. I think really the big picture still on the Eurozone is that whilst the recent data on the activity side have been reasonably encouraging, the economy remains very fragile. And I think to a large degree, the weak euro is an important facet that will ensure that the Eurozone is insulated from the apparent external weakness that's going on at the moment. And I think that the ECB is realising that. And I think it will be loath to implement a policy that could cause renewed rises in the euro and bond yields and perhaps threaten any fragile recovery, certainly talking this year, perhaps early next year.
Okay, let's talk, but there are other influences. Let's talk about those for a brief moment. In Greece, we have recently been treated to more or less a weekly pattern where on Monday, Tuesday, Wednesday, and occasionally Thursday in any week, we are told that the deal is this close, and this close means really, really, really close, only to find out on Friday, Saturday, and Sunday that both parties blame each other for the breakdown in negotiations, but they will meet again the following week and the whole charade goes through again. Is that not likely to exert further downward pressure again on bond yields? or at least induce further volatility, perhaps?
I think probably volatility is likely to be maintained whilst these sort of on-off talks continue. I think looking ahead, if Greece were to leave the Eurozone, or certainly the risks of that became even more heightened, then I think that certainly would have the capacity to push down certainly German bond yields, due to perhaps safe haven flows and the like, albeit obviously the impact on say Italian, Spanish, Portuguese yields is somewhat more ambiguous. On the one hand, the fall in German yields should lead to a fallback in yields, but equally that could be swamped by increasing risk premium due to uncertainty about their futures. As it stands, our central view still is that a deal will be reached, albeit I imagine there could be a can kick is the next stage, so that there's going to be plenty more uncertainty over the coming months. And I think in that environment, probably the spread over peripheral bonds will remain reasonably contained.
So to sum up, essentially, bond markets have returned to a more realistic view of bond yields. The inflation outlook is relatively benign, and there will be more volatility.
Yeah, I think that's a fair estimation.
And May, lead Eurozone Economist for Oxford Economics. Thank you very much.
Thank you.